It's that moment whenever you've seen that house and you've seen that picture for the 100th time and you're thinking, hey, I need to do something about this, but how much is a down payment? Let's talk about how much a typical down payment is. My name is Andrew Finney, and my passion is helping you make sense of real estate. If you need help finding a top agent near you, or if you simply want to drop me a line and say hello, my contact info is below. If you're new here, please go ahead and subscribe to this channel now and like this video. Thank you. All right, my friend, let's take a closer look at what the typical down payment is for a home. And before we begin, I do want to share with you to also be planning for your buyer closing costs. In general, your buyer closing costs amount to 2% to 4% on average across the United States. So make sure that you get with your local loan officer and your trusted real estate advisor to know how best to not only plan for your down payment, but also your buyer closing cost. The first thing that we want to identify is the 20% rule of a down payment, fact or fiction. Well, fortunately, we can quickly dispel this one as fiction.
Pure fiction. It's a total fabrication.
Now, while it is a fact that if you do have 20% of a down payment saved up for your new home, this is a really good thing because you won't have what's called private mortgage insurance. Private mortgage insurance is essentially a type of insurance if you or somebody else defaulted on their loan to protect the lender, to ensure the lender can still provide loans to other home buyers that are in the market. Having a 20% down payment is ideal. Now, one of the things I like you to think about when we're considering a 20% down payment is, even though it's going to save you some change in the form of not having private mortgage insurance, the very real reality is this: how long is it going to take you to save up 20% on, let's say, a $300,000 house? That would be $60,000. Now, perhaps you already have that in the bank. Perhaps you're working on saving that much in the bank, or perhaps you're like, hey, Andrew, you know, that would take me a decade or longer. This is where I want you to balance your situation with the realities of real estate. We know that real estate typically appreciates roughly 3% per year on the 100-year historic average in the United States real estate appreciation. If that's the case, and we appreciated only 3% a year, which is pretty low right now, but if we did that for 10 years, that's 30% appreciation for the sake of easy math. And I know some of you mathematicians out there are probably saying, hey, Andrew, but you're not compounding it. You're absolutely right, I'm not, for the purpose of an easy illustration. So when we take 300,000, we look at 30%, that would be what? 30% of 300,000 is $90,000. So if we needed $60,000 to have a 20% down payment and it took us a decade to save it, that same $300,000 home would have appreciated $90,000 by that time, while you were planning on saving up for a $300,000 home. That's where we need the trade-off of the down payments. So at this point, what you're probably wondering is, what kind of loans are out there? The type of loans out there can really be broken down into four main categories, being your conventional loan, your USDA loan, your VA loan, and your FHA loan. It may come as a surprise, but even with the conventional loan, if you qualify, you can get down to as low as a 3% down payment. With a USDA loan, a VA loan, you can get a 0% down loan. Now, the trick here is a USDA loan is for the rural areas of the United States, whereas a VA loan is available to active duty military service members and also veterans who have served honorably in the US military. When we look at an FHA loan, it's the closest type of a loan that's going to be comparable to the VA loan or the USDA loan in a different way. So when we're thinking about an FHA loan, there are a lot of different loan programs, but a traditional FHA loan is a 3.5% down loan. So even underneath these four broad categories and the differing down payment amounts required at the minimum level, they can actually get lower through what's called down payment assistance. So you can see you have a world of home loan options available to you. Now, the best way to find out which one's right for you is how? By simply picking up the phone and talking to a local loan officer today. In short, the 20% down payment myth is just that. It's a myth. You have a lot of options, so we know it's now fiction.
We got you.
The second thing to know is that you can get additional assistance through down payment assistance programs and outside sources. When we're talking about that, when you hear about down payment assistance loans or home as possible loans, I want you to understand there are pros and cons to these. Now, if you're in that financial position where you really do need that assistance for your down payment and or assistance in covering your buyer closing costs, rock on, because getting into home ownership will start putting money back into you in the form of home equity over time, and it'll also give you a stable amount of money that you'll know that you'll be paying out every single month, as opposed to being facing down increasing rents. That being said, the trade-off of a down payment assistance or home as possible loan in many cases is that it comes with a higher interest rate. So why would that be? You're probably wondering, Andrew, why do I have to pay more money if I need the help now for down payment assistance? So Fannie Mae and Freddie Mac say, hey, you know what? We're happy to help you get these type of loans, and we're happy to make a host of different loan providers available to you and back them with these type of down payment assistance and home as possible loans. But here's the trick. If we're going to be putting up your down payment and helping you with some or all of your buyer closing costs, then we need to be compensated. And the only way that they can get compensated for that is if they increase the interest rate on your home loan to pay for the program so they can continue providing it to others. Now keep in mind down the road, if interest rates go down, you can always refinance out of the loan, and you can chat that over with your local loan officer to make the most well-informed decision that's right for you. Just know you have a host of home loan options available to you. The third thing you want to know is it really so bad not to have a 20% down payment? As we identified earlier in our conversation today, having a 20% down payment is going to preclude you from having to pay a private mortgage insurance. While that will definitely save you money every single month by not having it, if the trade-off is waiting to get into home ownership and home prices continue to escalate, where does that leave you at the end of the day? Probably in between a rock and a hard place, right? So that's why I'm asking you to consider your options wisely, make sure that you know the pros and cons of your decision, and make the most well-informed decision that's right for you and yours. Generally with private mortgage insurance, you're looking at roughly a 0.5% to 1% of the total loan amount, which normally equates to around $50 to $200 a month that you'd be paying in the private mortgage insurance. Now, you might be wondering, Andrew, well, what happens if I'm okay with getting a conventional loan at 3% down, but then I get this 20% equity stake in my position, or what would be called in lenders' eyes a 80% loan to value ratio? Well, that's a good question. See, whenever you get to that point, you can actually call your mortgage service provider and ask them to drop your private mortgage insurance. They will drop your private mortgage insurance once you reach that 80% loan to value ratio. So keep an eye on that if you're going with a 3% down conventional loan option. Now, I would like to be clear, when you're talking about an FHA loan, they don't have private mortgage insurance, but they do have what's called a mortgage insurance premium. It does operate and behave a lot like the private mortgage insurance with one main kicker. The mortgage insurance premium will not drop for the life of the FHA loan. What does that mean to you? That means if you got a 3.5% down FHA loan because you may have found some attractive rates there, you found it easier to qualify for the FHA loan, these are common reasons people go with the FHA loan. But 3 to 5 years into the future, you might be thinking, Andrew, you know, I do believe I have that 80% loan to value ratio, but because I got into home ownership with an FHA loan, I'm carrying this mortgage insurance premium. What can I do about it? Well, get with your local loan officer again that assisted you in getting that home loan and talk to him about doing a refinance into a conventional loan product. Please be careful and please be extremely mindful not to do a cash out refi unless it's a situation that you need that money. I, as a trusted real estate advisor, do not advise to do a cash out refinance unless you absolutely have to. It's part of what led into the 2008 devastation with too many people cashing in on what we could call the equity fairy, right? The equity fairy being the home equity in your property. What the market giveth, it can taketh away. So we know that real estate goes up and down and all around. What we need to do is make a well-informed decision that's right for us when we do it. So when you consider your refinance options and you want to refinance out of the FHA loan into that conventional loan so you can drop that mortgage insurance premium and not have that private mortgage insurance premium on the conventional loan because you've reached that 80% loan to value point, then make sure that you don't do the cash out refi. Make sure that you're very clear on what you're doing and that you're making a well-informed decision that's right for you. The fourth thing to think about is that money in the bank is a good thing. So if we are talking about the reality of a 20% down payment, because maybe you do have that money and you are prepared for your 2% to 4% of buyer closing costs, awesome, rock on. But if it's going to tap out your bank account, is it really the best and wisest decision for you to make? Now, only you can truly answer that. What I'd like you to do is to consider the very real reality that what happens if you throw down all the cash that you have to get into your new home between the 20% down payment, those 2 to 4% of buyer closing costs, your moving cost of getting into the home, and maybe you decide to paint it too. Now you're completely tapped out financially and you have no cushion. Now we would like to see you have ideally 3 to 6 months of a cushion, also known as an emergency fund that provides you some security net if you need it. What happens if you got sick? What happened if unfortunately you lost your job? What happens if this? What happens if that? All these what ifs, right? How do we deal with that as people? We got to be honest with ourselves and we got to make a well-informed decision that's right for us. So I'd ask you and I'd implore you that even if you do have the 20% down, make sure that you're making a fiscally prudent move on your behalf, because the banks are going to be very unforgiving once you miss 3 mortgage payments. They're going to look to foreclose. Let's keep you out from doing that, because the last thing we'd want you to do is buy that brand new dream home, put that 20% down, pay for those buyer closing costs, start making it your own in a year later before close time. So let's help you make a well-informed decision that's right for you and your family. So now that you know more about typical down payment amounts, let's take a closer look at the steps to getting a home loan and how to determine your ideal home price. Looking forward to our next conversation. We'll see you in a few.